Nick Cregan, welcome to the Equities and Growth Assets Symposium.
Thanks very much for having me.
What's the Fairlight opportunity set look like?
Fairlight opportunity set is the global small and mid-cap market. That's about 5,300 stocks. To put that into perspective, it's about 40 times larger than the domestic equivalent small and mid-cap market. So Australians sometimes have it in their mind that the Australian market's quite large. It's about 3% of global market cap. So I think that investors are pretty well placed to extend their horizons and think a little bit more broadly about global equities.
Can you expand on your three-pronged selection process?
Sure. All of our investments are grounded in what we call a quality framework, and our definition of quality is return on invested capital. But we've got a slightly stricter definition of return on capital insofar as we make a lot of adjustments to the capital base to make sure we're getting a fully costed cost of capital, such as adding back amortization, depreciation, and every write-down that a business has made due to poor acquisitions. Now, that's our starting point, and from there we break the market into three further buckets. We've got what we call high-quality growth, stable compounders, and low-risk turnarounds. For the high-growth businesses, a little bit different again from the definition you get from an MSCI or some of the other risk products that are out there, insofar as all of our growth assets are profitable and they're trading at what we would call reasonable valuation. So that's kept us away from some of the faster moving parts of the market and where you've seen the true, I'll call it large drawdowns over the last sort of 12 months or so. For the stable compounders, they're growing a little bit more like GDP, maybe a little bit stronger than that, but they're taking out costs, buying back some stock, and we're getting pretty reliable 10 to 12% returns. And those businesses are more healthcare names and consumer staples, very, very stable businesses that during periods of equity market dislocation can provide some protection. The third bucket are the low-risk turnarounds. Here we're at pains to explain that at the core, these businesses remain highly profitable. They just need a little bit of love and attention to get back to maybe what's special about the business. So there might be a management team that needs to be moved along. They might need to divest some assets and to get back to sort of something that resembles a reasonable growth trajectory. So those three buckets tend to perform differently at different points in the cycle and smooth the returns for investors over long periods of time.
What are the key benefits of holding smaller companies in a broader portfolio?
The main benefit is the uplift that you get to returns. So we've got long data series providing some evidence or at least some comfort to investors that if you stay the course in global small and mid caps, you can expect to do a little better. Now, the smaller end of the market, which we use as a proxy for our market in the US, we have about 100 years worth of data that suggests that small businesses outperform large businesses by about 3% per annum over the last 100 years. So that's a pretty good starting point, right? The reason for that is essentially smaller businesses have a longer runway for growth. They get acquired by larger businesses, and essentially it gives you an opportunity sort of to hold these businesses for long periods of time to generate those kind of returns.
What are the key drivers of returns in the small and medium cap sector?
The main element is that you're really growing off a smaller base. So if you think about some of the mature businesses in the market, especially if you sort of ran a bit of a screen over what was the top 5 businesses in the world over a sort of 30-year period, you'd notice that lineup is always changing. And the reason for that is that once you hit a certain level of maturity, it's quite difficult to continue to grow. Smaller businesses obviously don't have that problem, and they're growing off a smaller subset. The opportunity for us is to make sure that we keep our fund size small enough and nimble enough to participate in that end of the market and really capture that tailwind of smaller businesses outperforming large ones over longer periods of time. Hopefully a few acquisitions within there to bolster our returns, but essentially the drivers are really a longer runway for growth, an opportunity to grow off a smaller base and to be acquired by larger businesses.
In terms of stocks, what are your key 2 outstanding contenders at the moment?
We're sort of spoilt for choice at the moment with the equity markets sort of punishing businesses, especially in the more stable and growth ends of the market. But our 2 key standout at the moment is a business called Temenos. Temenos is a business that services the banking industry. So you can think of core banking solutions and adjacent services. So onboarding of clients or online banking, et cetera, et cetera. So Temenos serves around 3,000 clients, 41 of the 50 largest banks across the world. and it is an incredibly resilient business. To give you a statistic, they have about a 98% customer retention rate. So I've heard it described changing your core banking IT provider, if you're a bank, is akin to open heart surgery. So it's not something that these banks want to go through particularly often. And the nice thing for these clients is that Temenos spends about 6 times that of the average competitor in the market in terms of R&D. So they're staying ahead of the changes in the banking industry, providing some really nice solutions for their clients. And the opportunity set for us, or the opportunity that's presented itself, is that essentially that business is going through a transition of its revenue model, moving away from what's called the old license and maintenance model towards a subscription model. Now, that can be fraught with danger, but we think that Temenos has the credentials and the history to make that transition quite smoothly. And our conversations with management are indicating that's going quite well. As recently as April, that business was sold down to 20 times earnings. It had traded as high as 60 times earnings, and it's been caught up in the malaise of the growth sell-off, and we think it's an outstanding opportunity. The other one that I'd note would be, I think that most investors in Australia, worth sort of pointing out at this point, we don't invest in Australia at all, but people will be quite familiar with REA here in Australia, so realestate.com. We have a holding in Rightmove in the UK. We've been sort of trimming that position on valuation and reallocating that capital into a business called Scout24 in Germany. So it's the dominant property portal in Germany. It's 60% larger than the number 2, with about 3 times the number of listings as the number 2 competitor. What we like about this business is very early in the journey of, by stealth, increasing the revenue that it's generating off each particular client. So there's a very established playbook of how these portals generally develop. So here in Australia, we're very well versed in this. REA, starting off with a base level of subscriptions, and then, to use a word that doesn't exist, premiumization of that subscription over time, and upselling their client base into, hey, if you want to be on the front page, if you want to have some photos, you need to pay a little bit more. And so Scout24 is very much at the beginning of that journey. We can see a very long runway of sort of 10 to 15% top line growth, uninterrupted by sort of what's happening in the machinations of global equity markets, given their subscription revenue. So we're quite bullish on those 2 names.
Nick, thanks for talking to us today.
Absolute pleasure. Thank you.